Welcome to Think Money with Benny. Here on the channel, we talk about investing in the stock market to produce passive income. If you're new here, I talk about how I grow my portfolio, what strategies I use, which stocks I invest in. That's what my content is all about. If this interests you, click the subscribe button so you don't miss any of my upcoming videos. And don't forget to hit the like button to help support the channel. In this video, I'm gonna show you how to roll a covered call on the Fidelity platform. I'm also going to take you through my entire thought process behind the trade that I'm in right now. This is not a hypothetical scenario where I play make-believe and talk about stocks pretending just to make content. This is real money invested in my portfolio. I'm all about being transparent and help you guys learn because that is how I learned. Now let's get it. The stock being discussed today is Beyond Meat, BYND. I talked about this company in my last portfolio update where I went through all of my stocks. Link to that video will be up above and down in the description. To recap, why do I own Beyond Meat? For two reasons. It's my spec play and I use it to make extra income selling covered calls. Do I believe in the company long term? Yes. Do I see it as a growing industry? Yes. Do I like the product? Yes. Can I handle the stock being volatile? Yes. Why do I ask these questions? To remind you that you shouldn't buy stocks that you don't believe in. When things go south in the market, it's not going to be a pretty situation if you don't know your risk tolerance. So just to review, what do we need to sell covered calls? Number one, you need to understand how options work. Two, you need to be approved by your brokerage to trade options. And three, you need to own 100 shares of that stock. If you're still buying 1 or 2 shares because you have a small account, then click off this video and get back to grinding and growing your stock portfolio. I remember I started with fractional shares, then buying 1 or 2 whole shares, then 5 shares, then 10, 20, 50. Right now, I'm able to buy 100 shares at a time with confidence, but that takes time to build from the ground up. See, a lot of new investors, they jump in headfirst wanting to make fast money overnight, but they don't want to put in the real work to build up a solid portfolio. But now I'm getting off topic. Let's get back to the video. As of right now, I currently own 100 shares of Beyond Meat with a cost basis of $140.80. I bought these shares on December 23rd last month. With this specific lot, I was able to get off 2 covered calls, one that expired the next day and another the following week, bringing in additional income. Up to this point, I have a total of $1,010 of realized profit from trading or selling covered calls on Beyond Meat. This is a mental cushion for me knowing that I have some wiggle room to play with. Now, this is where things get very interesting. Over the next 2 weeks, the stock begins to tank all the way down to 116. I thought, well, there goes my chance to sell weekly covered calls for decent premium. I was down 18% at one point. 2.5K in the red. And I told myself, remember why you bought this stock. So on January 11th, that Monday, Beyond Meat was $116. I looked at the weekly options chain and I saw that I could still collect some premium at a strike price around my cost basis. Really quick, let's go over how to sell a covered call, okay? So we have 100 shares. Search the stock on Fidelity, click on options, remove the dates that you do not want to see. Select calls. Press apply. Once you have your strike price, click on the bid price. The action is sell to open. Enter 1 in quantity because we are selling 1 contract. The order type is limit order. Enter your asking price and submit your order. Once you get filled, you are good to go. Back to the story. On the 11th, last Monday, I thought, okay, the stock is down right now. Let me just sell a call to collect any extra money I can. This is where I made a mistake. I violated the #1 rule when it comes to selling covered calls. I sold the covered call at a strike beneath my cost basis. My average cost for these shares are $140.80. I sold the call at $137, for which I only collected $20 in premium. Honestly, I don't know what I was thinking. I just thought there's no way the stock could jump back up past 137 by Friday. But of course, anything can happen in the stock market, right? News broke out about Taco Bell partnering up with Beyond Meat on Thursday, and it sent the stock flying back to $144 a share. At this point, my covered call was a total bust. I was just going to accept the $360 loss from my shares being called away at $137. But I still had 1 day left remaining until my contract expired, so I thought anything can happen. All I need is Beyond Meat to have a red day and pull back under 137. Sure enough, that's what happened early in the morning. Now, my contract pulled back to being worth as low as $150 at one point. But I wasn't sure if I should buy it back to close the position or just let it play out and hope that the stock closes under $137 that day. As I saw the stock zigzagging, I decided to just buy back the contract for $250, wait for a spike up, and sell another covered call above my cost basis at $144 going 2 weeks out. I was able to collect $600 in premium. Let's go over how to roll a covered call. First, you'll need to buy back your open position. Click on the existing covered call, click on trade. The action this time is buy to close. Enter 1 under quantity, order type is limit, enter the price you want to pay, review the info and submit your order. Once it gets filled, you have closed the position. Next, you'll want to sell a new covered call farther out into the future. You want to collect more premium to cover the loss you took for buying back the previous contract and still collect enough to profit. To roll your covered call, search the stock, click on options, select a date farther out, select calls, press apply. Once you have your strike price, click on the bid price. The action is sell to open. Enter 1 in quantity. Order type is a limit order. Enter your ask price and submit your order. Once you get filled, you have successfully rolled your previous covered call. Now let's break down the math with this trade. Initially, I received $20 in premium for selling the 137 strike. It obviously backfired on me, and I chose to buy back that contract for $250. At this point, I'm in the red $230. I then rolled my call and sold the 144 strike expiring January 29th for $600 in premium. This covers the $230 loss and leaves me to make a profit of $370. Whether my shares get called away or not, we'll have to wait and see. I also have the option to buy it back if I'm in profit before expiration. As it stands right now, I'm up 14% in profit, but it's still too early in the contract. Who knows what curveball Beyond Meat stock is going to throw my way in the next 2 weeks. I know there's a lot of information in this video which might not make sense to beginners. This video is targeted for a specific audience when it comes to options trading and selling premium. So what's my lesson with this experience? Make sure to not sell covered calls at strike prices under your cost basis. Yes, I already knew this, and yes, I thought I could get away with it, but you just never know when a stock will skyrocket on good news. Fortunately, I was able to correct my mistake and put myself in a winning position. If you have a question that you'd like me to answer, just comment down below and I'll answer it in my next video. I hope you got value from watching this video. If you did, go ahead and smash that like button, subscribe if you haven't already, and I will see you in the next one. Peace.